Welcome to the Footprint course, Unit 1. Over the next 19 slides, I'm going to give you a brief introduction to the layout of the course. I'm also going to show you some of the key teaching methodologies utilized throughout the course. I will then briefly introduce the Footprint tool, how it works, as well as a practical example of the Footprint in action. Now, let's get straight into a brief video about the Footprint course. Welcome to the Footprint course. My name is Brannigan Barrett and I'm going to be your mentor throughout this course. My background currently includes 7 years of proprietary trading, 6 years of mentoring, and this is the second course I've created, the first being the Market Profile course launched earlier this year. Currently I trade across multiple asset classes including bonds, equity indices, currencies and commodities, and across multiple time frames including both day trading and as well as obviously swing trading. My trading philosophy is very simple. It's a gradual, consistent pursuit of high performance developed through strong habits, smart processes, and simple, effective trade strategies. So why has Axia Futures created a Footprint course? Well, very simply, there's an extremely high demand for it, given the fact that there's very little education out there about the Footprint tool. Moreover, a lot of the current tools are extremely backdated. Lastly, the Footprint is an extremely objective, fact-based tool. Now, by this very nature, if you're developing strategies based on facts, it will allow you to develop confidence in those fact-based strategies and ultimately leverage up your favorite strategies. Well, firstly, all of the principles we're going to teach, we are going to practically apply to live market examples. More important, some of the complex principles we're going to then put onto the blackboard and explain them in layman's terms. We're then also going to include drill sessions at the end of every one of the strategy sessions to make sure that not only do you grasp the principle, but you can also apply the principle to some of the drills we give you. We will then also have live Footprint streams where you can follow a mentor and see how he utilizes the Footprint with various strategies. Included is templates. We're going to spend a lot of time developing templates so that you can eventually learn to go and adopt and include your own strategies utilizing the Footprint. There'll also be a peer-to-peer learning process where you can effectively speak to not just your mentors, but you can also engage with some of your other peers utilizing and using the Footprint course. Lastly, there will be exclusive bonus material that will only be available to those that have taken the Footprint course, and this will cover a debrief on how to use the Footprint, but also it'll cover templating various strategies from me, your mentor. So how to take the course? Well, don't rush. There is definitely going to be a temptation to get through the more boring theoretical principles and move very quickly on to the strategies. But what I suggest you do is take the time to learn the principles. The reason is simple. If you learn the principles, you will eventually be able to develop your own strategies. So, once you've learned the basic principles and you can understand them, ensure that you can apply those principles through live market examples. Lastly, make sure when you are learning these principles and applying yourself, record everything you're doing. Record all the footprints, record all your execution, and do ensure that you debrief all of the patterns that you're recognizing on a day-to-day basis. Remember, it takes time to develop a new skill, so don't rush through this process. Some of the best advice I can give to all of our young and developing traders is very simple. The trader who approaches the market with the most simplistic approach will have the greatest outcomes. Remember that. The more simple you keep it, the greater and more effective your outcomes will be. My favorite trading quote: developing mental strength is all about habitually doing the things that no one else is willing to do. Good luck for the Footprint course. The index is a wonderful overview of what you can expect to see throughout the course. It's broken down into 3 sections: an introductory section, which is units 1 to 5, an intermediate section, which is units 6 to 11, and an advanced section, which is units 12 to 15. Now, in basic terms, unit 1 to 5 includes predominantly theoretical as well as practical application of the Footprint principles and methodologies. From units 6 to 15, we solely focus on building strategies, executing strategies, as well as building your own templates on those strategies. Now, some of the key features you can expect to see throughout all of the units begin obviously with theoretical application. We then also have the practical application of these theoretical principles. What I found in my first course was that whilst we had a great deal of practical application of the theory, there was a real desire for a lot more practical application, and we've taken heed of that, and that's why we're going to have a number of practical examples throughout the Footprint course. All of them include live market strategies. Now, these live market examples will not just focus on the Footprint course, the Footprint tool, but they'll include the Footprint as well as the price ladder and as well as traditional candlestick charts. The reason for this is very simple. Obviously, a lot of you guys taking this course will be very familiar with not just the DOM or the ladder, but also utilizing normal candlesticks. So to ensure that it's not completely stepping out of your comfort zone, we've incorporated all 3 into the practical examples. Then you can see in every unit 6 to 15 we will have a template. So we've designed a very unique template that you will fill in for every single strategy so that you can form very strong habits whilst developing these strategies in unit 6 to 15. Then in every unit 6 to 15 we'll also have a Blackboard learning feature, which predominantly focuses on the Blackboard, on the smartboard. I get to annotate the examples with you, point out the key features, really sort of break it down into layman's terms to ensure that you're not missing out on any of the key concepts. We then obviously have Footprint drills. Now, this is quite a favorite of mine. For every one of the strategies, there will be a drill-based session. It'll be broken down into 2 drills. The first drill will be solely yourself. I'll be completely on mute. You'll be watching the video through, trying to adopt and learn the strategy taught within the unit. Once you've done with drill 1 and you've given it your best shot and tried to adopt the strategy, in the second drill, I will then show you effectively the execution, show you the methodology, and then hopefully you can learn from it. Now, the reason we've gone about it this way is, and again, don't be tempted to start on drill number 2. It might be frustrating going through drill number 1, but I really, really want you to, spend time trying to figure it out for yourself. The reason being is human psychology. When we figure out something for ourselves, we tend to hold that memory for a lot longer, and we can also recollect that memory a lot easier in the future. So that's why I really don't want you to skip to drill 2. First, try it on your own, really battle through, try and figure it out. Once you've sort of exhausted yourself, then go through the drill 2, which I will obviously mentor you through. Okay, then we're obviously going to have, through every one of the units 6 to 15, a little bit of psychology and motivation. Now, I've picked some of the most important topic matters that I've spent time with, learning and adopting throughout my career. Things like understanding liquidity, things like understanding, what habits make really effective traders. So throughout each one of those units 6 to 15, I'm going to share some real good psychology and really try and motivate you and give you a little bit of a better understanding of some of the things I've learned throughout my career. Obviously then, also in units 6 to 15, I'm sharing some additional reading with you. This is like my top 10 reading list that I think every trader needs to read. I'm going to explain to you why I think they're important reads, how they relate to trading, obviously, and hopefully you can then go and read those books and adopt some of the understanding that I got from those books. And then obviously lastly, throughout every single unit, we've got the peer-to-peer learning function. This is the live chat function that you can talk and engage, not just with a mentor, but also with your peers whilst doing the course. It's so crucial, guys. Remember, you're going to learn so much more from one another. You're going to get so many more examples from each other if you're sharing your ideas, sharing your strategies with each other. So that's predominantly how the course is broken down with its key features. As you can read, obviously units 6 to 15, each one is a strategy. There are 10 unique strategies throughout the Footprint course. And once you've completed all 15 units, you can then move on to unit 16, the bonus material. Obviously, once you get to unit 16, you can then go and view a debriefing, a strategy session of how I would take the tool at the end of the day, how I would go look for new strategies, and how I would apply my understanding to the Footprint tool. And do note, guys, this is exclusive material only. It will only be for the Footprint subscribers. I'm very excited to share with you the Footprint 30-day challenge. I adopted this habit whilst training for my Ironman earlier on in 2017. You know, I'd always been one of those kind of guys that would just go out for a long run or get on the bike for a long bike ride, and eventually I'd experience things like burnout and just a lack of enthusiasm and motivation. And you know, I started taking a training program, and all of a sudden the results, the consistencies, the motivation, everything just started improving as a result of following some form of a plan. And that's exactly what this 30-day challenge is. It's me challenging you to stick to a 30-day plan. Now, as you can see, as per the calendar, I've broken it down into 5 weeks. Okay, now within those 5 weeks, I've broken it down into 7 days a week, i.e. Monday to Sunday. Now, what I propose you do is take the unit on the day that it has been allocated. Now, as you can see, obviously, some days have been allocated to rest. Please make sure you take these rest days. Just like athletes have to take time off and allow their bodies to recover, it's the same with trading. You have to allow your mind to recover. You have to allow your mind to absorb the information it's taken in. Also, after every strategy unit, I have allocated a day of practice. Now, these days of practice can be utilized for one of two things. One, you can either play catch up on maybe a unit that you haven't completed yet, or you can even go back over the strategy unit just to make sure you understand the strategy. More importantly though, if you do understand it, spend the entire hour or two just mulling over charts, looking for that strategy in a number of markets. Utilize that trial of yours and make sure that you fully understand the strategy and can apply it to live market examples. Then also, what you will notice is that it's imperative that you only begin the trial of the Footprint chart on day 2, i.e. after you've completed unit 1. Note, the trial does end after 30 days, at which point you can continue your trial, but you will need to then purchase the Market Delta charting software. Also do note, once that charting software trial finishes, Axia Futures will then give you a 1-month free subscription to our premium streaming service. The purpose of this is twofold. Obviously, a lot of our streams do cover the Footprint tool in action, where you'll hear from numerous traders referencing the Footprint tool, why they utilize it, where they utilize it, what sort of trade strategies you can look out for with the Footprint tool. Secondary to that, obviously, if you join the live Premier membership, you will also then have access to the peer-to-peer community learning section, and this is a chat room where you can engage with not just a mentor but also your fellow peers who are completing or who have completed the course and who are utilizing the tool on a day-to-day basis. So guys, just make sure, take this challenge, don't skip ahead. Remember, the reason I set out this challenge is so that you can avoid things like fatigue, avoid getting demotivated, avoid the stress of thinking that this is a very complex tool when in essence it's very, very simplistic. So hopefully the 30-day challenge has got you really excited about what's to come in the Footprint course. If it hasn't, then the outline of the 10 strategies you can expect to see ought to do the trick. So some of the strategies you can expect to see include both momentum as well as counter trend strategies. We've done this for a very good reason. Not all traders are alike. Some traders don't like to necessarily go with the flow. Some traders like to go against the flow. Equally, some traders like to be a little more passive in execution, whereas some traders like to be more aggressive. So we've created 10 unique strategies that will include all sorts of strategies for a whole number of different types of traders. Now note, obviously, units 5 to 11 will include Footprint standalone strategies only. What this simply means is that you only require the Footprint tool to not just interpret but also execute these unique strategies. The last 4 strategies in units 11 to 15, you will require not just the Footprint tool, but also a little bit of context. This context we will build through utilizing candlestick charts as well as basic fundamental understanding around the various trade strategies. Let's now briefly go through the trade strategy grid. It's broken up into 2 basic elements. First will be momentum strategies and then counter trend strategies. Now, within the momentum and counter trend strategies, you will note that some of them will require passive execution and some of them aggressive execution. This simply means passive is where you're waiting for the market to come to you and give you a certain price. Whereas aggressive, you have to go to the market and make the market. Now, in terms of the momentum strategies, some of the Footprint standalone strategies you will see are absorption and auctioning, auction imbalances, and the initiative drive. In terms of then the more contextual and Footprint trade strategies on a momentum side, you will see the Footprint delta and position unwind as well as breakout trading. In terms of counter trend strategies, the Footprint standalone will include failed break of support and resistance, hiding behind the elephant, as well as exhaustion highs and lows. And then in terms of counter trend strategies that require context and Footprint, there'll be risk event trading strategy as well as key auction reversal. Those are the 10 types of strategies you can expect to see throughout the Footprint course. So now that you know what the 10 strategies are that we're going to cover throughout the Footprint course, I'm going to give you a little idea of what you can expect to see within each one of those strategy units, 6 to 15. So what I've found through experience with particularly mentoring a lot of younger traders is they have all the energy and all the the willpower to want to succeed, but they never have a very strong, disciplined, routine approach to analyzing and templating the markets. And that's why we've developed the trade strategy learning process loop. So this loop, very simply, is just a manner in which we can observe the markets in an exact manner to develop a consistent approach over time. So what do I mean by this? So take, for example, in Unit 6, when we begin the strategy, we're going to start off by observing the strategy. By observing it, we're going to talk about things like time frame participants, market context, trade locations, and volatility. These are all the sorts of characteristics that will allow you to observe when this trade strategy could potentially be in play. So once we've learned to observe the trade strategy, we're then going to learn to identify when that trade strategy is in play. Certain characteristics we're going to look at will include volume, time, flow, delta, and relative change. These characteristics are going to allow us to identify when the trade strategy is in play. And lastly, we're going to work on execution. So observing the trade strategy is important, identifying it is also important, but most important is learning to execute effectively and efficiently. Now within this execution, we're going to spend time looking at the entry points as well as timing of trade strategies. We're going to talk about where to place your stops as well as where to place your targets. We're then going to also finish talking a little bit about risk reward within each trade strategy, and lastly, how we can leverage these trade strategies to ultimately get big. This loop you're going to find throughout the entire unit 6 to 15. The reason being is that I want you to learn to develop not just a very strong habit, but a very strong approach to looking at the markets. By looking at the markets through a templated approach, you are going to learn to develop a consistent approach whereby you can recognize patterns over time. So just like I've set out a 30-day challenge for every one of you taking the course, I've also set out objective outcomes for me, the mentor, to achieve within each one of the units. These 6 objective outcomes include the following. Firstly, I really want you to understand the principles within each unit that ultimately drives market price. If you can fully understand and grasp these principles, you'll not only be able to execute the trade strategies within units 6 to 15, but you'll also be able to develop and adopt your own unique footprint trade strategies. The second outcome I'd really like to achieve within each one of the units is to teach you to learn to listen to the market. Rather than take a biased or opinionated subjective approach to the markets, I want you to learn to become very objective, drawing upon the fact-based information that is within the market, and ultimately learn to listen to what the market's saying. The third outcome I'd like to achieve is for you to be able to practically apply each one of the trade strategies. The fourth outcome is I want you to be able to develop your own unique trading template. Obviously, throughout units 6 to 15, you will adopt a template I've created for you. But over the long run, I want you to adopt your own template that's personal to your trade strategies. The fifth objective I really want you to focus on and really adopt is minimizing risk first and maximizing gains after. The reason is simple. Every single successful trader I know or have come across all focus on managing risk and becoming the perfect risk manager. The last outcome I really want you to achieve, and I really want you to understand, is that you only need one trade strategy. You only need to be a master of one trade strategy to be not just extremely successful, but also extremely prosperous and wealthy. So remember, guys, skills are developed through time and experiences. Experience is the ultimate teacher. I can teach you all the principles, all the strategies in the world, but at the end of the day, you are going to have to take your understanding and experience things for yourself and develop your own unique trade strategies. Over the next couple of slides, I'm going to briefly introduce the footprint tool. We'll also look at the Blackboard learning feature, where I show you how the tool effectively works, as well as introduce a live market example so you can see the footprint tool in action. Now let's take a look at the brief history of the footprint tool. So originally, back in the day, traditional puts, you used to have a squawk simply quoting the volume traded at each price. Now, traditionally, if you were to chart what was going on, you would simply just see the high, the low, the open and the closing prices on any given day. So since 2003, the footprint tool became publicly available. However, in my experience, the footprint tool by and large has only started to be fully utilized by professional traders since early 2012-2013. In terms of obviously what the footprint tool tells us, it effectively captures all the actual activity at each price. So in essence, it's telling a story in much greater detail at each price. Sometimes I like to summarize it as the footprint is nothing other than the physical interaction taking place between buyers and sellers over a number of prices. Now, in terms of my personal experience, I've been utilizing the footprint since pretty much 2012, 2013, which gives me roughly 5 years of personal experience utilizing the footprint tool. Now, the reason that we've kind of created this course is very simply, if you were to go and type into Google or YouTube anything about footprint or how to utilize the tool, what does the tool actually effectively do, it's very difficult to find any kind of meaningful information and education on the footprint tool. And that's why we've created the footprint course. So what we're going to do throughout this course is we're going to teach you how to effectively utilize the tool, also how to develop a contextual understanding, and lastly be able to not just execute the trade strategies we teach you, but also ultimately develop your own unique trade strategies. Now in the next slide, we're going to take a look at why you should consider utilizing the footprint tool. We're going to spend the next slide talking about some of the most important reasons why you could consider adopting the footprint tool. To start off with, what you can see depicted in the slide is a traditional candlestick and to the right of it a traditional footprint one rotation. Now don't get too concerned about what effectively the footprint implies in terms of the numbers and the X's. We will get onto that a little bit later in this unit and obviously later on in the course. But for now, what I want you to understand is some of the basic reasons why we utilize the tool. So first and foremost, the footprint displays time, volume, price and order flow in one single graphic. So within this single rotation you can see in the slide, we can obviously see time, volume, price and order flow. Now if we're to compare that just to a basic candlestick, the candlestick will offer obviously time as well. It will also offer volume, but only total volume. So it won't offer volume at each price, just simply total volume. It'll obviously also offer price, the candlestick, and it won't offer order flow either. It'll simply show you the net result of buying and selling interaction. So we can already clearly see that the footprint adds two unique elements in order flow and volume at each price over the traditional candlestick. The footprint then offers a deeper principle-based understanding, and what we mean by that is you not only look at where the market opened and closed and make big principle decisions on that, but you can look at what is occurring at each individual price and understand the logic behind why price is doing what it's doing. The footprint leaves an informational trail. So what we mean by that is we can very often pick up where buyers and sellers are positioning themselves, where their stops might be, whether or not those sellers and buyers are aggressive or passive. This informational trail can be extremely valuable information when obviously charting the markets. The next reason why we utilize this tool is that we can actually develop a unique edge. Why? Because we're moving away from the traditional high and low, open and close only features of a traditional candlestick. With a footprint tool, we can identify the interaction and intentions between buying and selling participants as it gets imprinted within a footprint. Note, with a footprint tool, we can also see the aggressive and passive interaction, initiative and responsive price action, the positioning as well as relative changes occurring at each price. The footprint is a wonderfully strong visual graphic that summarizes a lot of information in a very simple graphic. And humans tend to recognize and remember colors a lot easier than numbers. So by depicting it in colors, we can see very clearly the information a lot easier and make decisions a lot quicker. Obviously, with the footprint being a new tool relative to the candlestick, there is a longevity of edges that you develop with the footprint tool. So each strategy you develop with the footprint, you're going to be using leading information rather than the traditional lagging information. Also, the footprint will allow you exact manageable risk with each strategy. Also, you can define very specific unique strategies with the footprint tool. And lastly, one of the most important reasons why you want to consider utilizing the tool is that it can be utilized across all markets and all time frames, making this a highly effective trading tool to consider. Let's now go and have a little bit more of a detailed look as to what the breakdown of the footprint tool looks like. So now that you've got an understanding as to why exactly professional traders choose to use the footprint tool, let's go and look a little bit deeper inside the tool so you can see the various elements of information that come out in one simple graphic. So let's start with obviously price. Now what you can see in front of you is a number of footprint rotations. So all in all, within the graphic in front, you've got 6 different rotations. Now note, these rotations can obviously be, they can be based on time, or they can be based on a certain number of ticks within a rotation. Again, as we go through the tool in Unit 2, you'll understand a little bit more about the various options you can choose with regards to the trading tool. So the first thing to look at is obviously the footprint shows us what is occurring at each price. Now, on the right side of this graphic, you can see how the prices are represented horizontally. Second to that, obviously, we can see the volume within each price. Now, not only can we see the total volume in the summary box below, but we can also see what is happening at every single price in terms of volume. Now traditionally a candlestick will simply just show us one rotation, the open, the close, the high and the low. However, with a footprint we can see that every single price that the rotation is traded over, we can see what the volume transacted at every single price looks like. And that is defined with a simple 2 numbers. Now these 2 numbers simply represent the interaction at the price. On the left side of the box, we can see what the sellers have sold at that price. On the right side, we can see what the buyers have bought at that price. The X in the middle simply differentiates between the two. Now the net difference between what is on the left and the right is what we call the delta. Now that delta is nothing more than the order flow. So it's telling us at each price who has ultimately traded more volume. Is it the buyer or is it the seller? And that gives us an understanding of the order flow occurring at each price. Now in terms of the delta, what we sometimes want to look at over a series of rotations or time is the cumulative delta. So that's to summarize, that's simply the cumulative order flow. So it's the total delta that's been occurring over a number of periods or rotations. That can be seen in the information box below. The next element we look at is time. So again, like I mentioned, each one of these rotations can be time-based. They could be 5 minute, they could be 30 minute, they could be daily, or they can be based on rotations. Now, the next thing we look at is relative changes within the tool. And this is where the tool is highly effective because we can see 2 types of relative change. The first is with regards to the color. Now note you'll see darker and lighter colors. The darker colors simply represent higher amounts of volume being transacted at specific prices, whereas the lighter volumes represent lower relative volume. The second type of relative change we can see is in the summary box below. We can see the relative change between volume, as well as delta, and obviously the net change in cumulative delta over a period of time or rotations. The last thing we can add to the footprint tool is other types of trading tools such as volume weighted average price, market profiles, the 50% or the midpoint of the market with the high, the low. We can add a number of other traditional trading tools to the footprint tool. So this is an expansion now of the footprint tool. What we're going to do next is we're going to actually look at a Blackboard example and highlight all of these 7 elements on a practical example utilizing the Blackboard. So welcome to the first of the Blackboard learning series. This is going to be an overview of the footprint tool. Now, the first place to begin is to talk about the traditional candlestick. So what you're effectively looking at here is the footprint tool in its entirety. Now, within each one of these rotations, I've included a traditional candlestick on the left side. And the reason is I want to really sort of drive home the differences between, if you were looking at just traditional candlesticks versus if you incorporated the footprint tool. Now,
what we can see straight away, obviously if we have the candlesticks there, we can see the traditional open and close, and obviously we can see the high and the low. However, what we cannot see is all this information in between, which is known as delta or volume at each price or order flow. Okay, so by simply not having the footprint, you are discounting or you're losing out on a whole host of information that exists to market participants. Okay, so with that in mind, let's drill into the footprint chart and look at all the various elements as we discussed in the previous slide. So the first things first, price. As we can see, price is being depicted on the right side of our chart. Every one of these segments is occurring at one price. So this would be price point 70, 71, 72, 73, etc., etc. So we can obviously see the footprint over a number of prices. The next thing to look at and talk about is time. Now, the footprint can be depicted in two different formats of time. The first is a typical traditional time-based format where we could select, say, a 5-minute footprint or a 30-minute footprint or a 60-minute footprint. Simply, each one of these rotations will be based on the selected time. Now, for those of you that are more swing type or longer term traders, you can even create the footprint utilizing daily footprints. What professional traders do look at is we do have a daily footprint so that we can determine what the net positioning is, what the net delta is at the end of each session. Okay, the other second type of rotation type we can have, which is also time-based, is simply a point and figure. Now in this example, we can see a point and figure because we can see that the time is varying between each rotation. So each rotation in this example is simply based on a point and figure. What this means is that every time the market moves a certain number of prices in one or the other direction, say 7 prices up or down, it creates a new rotation. Now throughout this course we are going to talk about both about time-based rotations as well as point and figure rotations, and the reason being is very simple. Certain strategies like momentum-based strategies or flow-based strategies tend to be better revealed utilizing a point and figure chart, whereas more sort of relative type change strategies and counter trend strategies can be better seen utilizing a time-based rotation. Okay, now that we've spoken about the rotations, let's turn our attention and talk about volume. Now, there's two types of volume that you'll see on the footprint chart. The first is the total volume within each rotation. The second is the total volume, or the volume being transacted at each segment of the footprint. So let's take a look at this rotation now, and let's sort of magnify this specific rotation or this specific segment of the footprint at price 74. So what we've got here is 782 times by 378. Now all this represents, on the left side, we've simply got what the sellers have sold at price point 74. On the right side, we have got what the buyers have bought at price point 74. Now the net difference between the two of 404 is simply regarded as the delta. So it's the net difference between the interaction between how much volume a seller has sold and how much volume a buyer has bought. Now that net difference can be represented as a positive or a negative. Now when there is more selling at a price segment than there is buying, we tend to get a negative number. And when there is more buying than selling, we get a positive number. So what you would see if, for instance, in this example is we would have minus 404 in this current segment because there's more selling at this price than buying. Okay, now what you'll see obviously is that over the course of a rotation we get a cumulative delta. and that cumulative delta is shown to us in the second box of the summary statistics. And we can see that the net delta, or the net cumulative delta within all these price points, equates to minus 820. And what that's telling us is that there was more selling than buying in this entire rotation over price point 70 to 80. Now again, that in its own doesn't mean much, okay? For now, we're just looking at purely what every single piece of information on this chart represents. So the next thing then is to talk a little bit about order flow. So all that order flow is it's the manner or the interaction occurring at each price. Okay, so as a basic example, what we can see is that the order flow as the market came down to price point 65 was that the market quickly navigated away once, and twice it navigated away from this point. So we can see the order flow is showing us that there's some buying occurring at price point 65. Now again, order flow we will spend a lot of time talking about as we begin to develop strategies in units 6 to 15. Now as mentioned, the cumulative delta is simply what's happening over all the rotations put together in a chosen time frame. So what we mean by that is that, simply put, we can see that each rotation is giving us a delta. Now if you go and you work out the total of that delta over a period of time, you are going to get the cumulative delta on the day. And as you can see, it's a running total of the delta throughout the session. You can then also see the total volume throughout the session as mentioned earlier. Again, we can see the total volume within each rotation. Now, where this total volume comes in handy is that the total volume allows us to draw upon certain relative changes. So what we can see if we compare, for instance, this rotation to the next rotation is we can see that we went from 11,721 contracts all the way down to 4,752. So a real relative drop-off, okay? Almost a massive shift in the type of volume, okay? We obviously from the previous rotation we nearly doubled, and then we more than halved after in the next rotation. Okay, so we can draw some really nice relative changes in terms of the volume. Now, in terms of talking about color shading, this is the real sort of crux. This is the real sort of amazing, incredible part about the footprint tool. Okay, the reason being is that what the footprint tool does is it shows us the relative change in interaction through color. Now colors are wonderful because we can very quickly see these colors and make very fast decisions upon them. Whereas if we were just trying to calculate the net change occurring at each price, that in its own wouldn't allow us to make effective quick decisions. So let's look again at these colors, and let's now take this segment that we had from earlier. So what we can see, we said there's a negative 404 delta. Now, when we have negative deltas occurring at a price, we will always get red colors. When we have positive deltas, as we can see in this example, this will be positive 5, we get blue deltas. So when the buyers effectively are trading more volume at a price than sellers, we get a blue footprint segment. And when the sellers are selling more volume than the buyers at a segment, the color will be red. Now what you can see is very quickly is you can straight away see that the sellers were more, the sellers were more, the sellers were more, buyers more, buyers more, sellers more, sellers more, sellers more, sellers more. So we can very quickly see who's winning the net interaction over a number of prices. Now let's take it a step further, and this is again also where the footprint is very, very unique. We then have a number of shades. Okay, now as we'll talk a little bit about in Unit 2, you can obviously adjust these shades, but for reference, we're only going to utilize 6 shades in this example. So of those shades, you get three shades of blue and 3 shades of red. We're going to call those light shade, medium shade, and dark shade. Okay, now all the shade is telling us, it's showing us where the delta is higher or lower relative to within the rotation. So what we mean by that is, if in this example there's a very high negative delta, as we said, of minus 404. Now if we compare that to the lowest one, there's only minus 6. So the more negative the delta is, the darker the shade of red. And the lower the delta is, the lighter the shade of red. And the same is for the buying. Okay, so obviously with the buying, we can see in this example, we can see positive 75, therefore it's blue because there's more buying volume than selling at this price point. But then as we go a little bit higher, we can see a slightly darker shade of blue. Why? Because the delta is obviously more positive, as there is more buying interaction occurring at this price. And the darker shade of blue occurs where we have the highest positive delta at price point 80. Okay, so to summarize, blue is when there's more positive delta or more buying interaction at each price. Red is when there's more selling interaction at each price. The shades vary according to how much of an interaction, in other words, how positive the delta is or how negative the delta is. Now, in terms of the next aspect, what we can add on to this chart is we can obviously add traditional technical tools. So we could very easily add a market profile onto the right side. We could have the volume weighted average price. We could have the Bollinger Bands. Okay, we could have all sorts of trading tools onto this footprint tool. However, and this brings me to the next point, be very, very careful in trying to add traditional trading tools to the footprint. And I'll tell you why. The mistake a lot of traders make is that they're trying to take the information, i.e. what's in front of you, and they're trying to add a number of different tools in hope that they can develop a strategy. Now what I'll tell you is that the footprint tool in its own, without any additional tools, so we get rid of the profile, we get rid of the volume weighted average, get rid of the Bollinger Bands, this tool on its own as a standalone tool gives you more than enough information to make trading decisions on. Remember guys, as a rule of thumb, okay, take this from someone who's had to learn this lesson the hard way over the last couple of years. A trading tool is not a trade strategy. A trading tool is merely there to take the information and summarize it in a manner that you can execute based on a unique specific strategy. So let me repeat that. We're simply taking this information and we're putting it into a condensed summary so that we can make a decision. We're not using the tool to make a decision. We're utilizing the summary to make our strategy-based decision. Okay, so don't fall trap to informational overload. And remember guys, like I've said to you, and throughout this course, I'm going to keep the settings very, very standard, very specific. I'm not going to alter the tool very often and very much. Why? Because I want to keep this simple so that you can develop a very consistent approach to utilizing the trading tool. Good luck, and I'll see you throughout the rest of Unit 1.
So I hope you enjoyed that example on the blackboard, and hopefully that really gives you a good understanding now of exactly what the footprint tool incorporates relative to, say, a traditional candlestick tool. Now, on the next slide, we're going to talk about some of the key principles of a trading tool and what you should be utilizing a trading tool for. Now the reason I wanted to discuss this very early on in the course is that one of the biggest errors I see a lot of young and developing traders make is there's an over-reliance on the trading tool to make decisions. Now, one of the key principles of a trading tool is that the tool is there to extract information in a meaningful way. So, like I showed you in the example on the blackboard, the footprint is merely taking all the information available and it's putting it into a summarized version so that I as a trader can make effective decisions. Now, by that very nature, if it's summarizing all the information, it's effectively simplifying and reducing all the noise. The next thing that a trading tool is very effective for is for creating various reference points or interaction points within the market. So the tool shows us simply where a market might have stopped, where a market might have turned around, where there was aggressive buying, where there was aggressive selling. So these interaction points we can lean on for future reference. A trading tools also allow us to develop certain patterns. Now note, make sure that you don't become too reliant on the trading tools for decision making. The tool is simply there to summarize the information, and you then need to develop strategies which you can then utilize the information to execute upon. Now what we're going to talk about over the next couple of slides is we're really going to drill down into this concept of lagging versus leading information. I'm going to show you across a number of different trading tools how the footprint is effectively very superior in a number of ways relative to some of the traditional tools. When we get to units 6 to 15, we're going to start developing trade strategies. Every single practical example within the trade strategy units, we're going to be utilizing all three tools combined. The reason is very simple. The price ladder allows us to perfect execution. The market profile or candlestick allows us to develop context. And the market footprint allows us to develop confidence in our execution. Therefore, we can leverage up on our favorite trade strategies. All three of these tools together combined allow us a cross-pollination between tools so that we can make much better trading decisions. Now, when we move on to the next slides, we're really going to highlight the differences between all the different tools so that you can see how it's not a case of necessarily being good at one tool, but being very good and have an understanding of all the various tools together so that you can make powerful trading decisions. So what you have in front of you is 5 different trading tools. Now I've put them from left to right in terms of lagging information versus leading information. Now let's talk a little bit about this concept of lagging and leading information. Simply put, lagging information or tools that utilize lagging information and summarize them, effectively they're taking information that the market has already received. In other words, the information is no longer, not that it's not important, but it's no longer leading information. Now the problem with lagging information is that the market has already had time to absorb and act upon that information. So what we can see in terms of the most lagging are traditional candlesticks. Next to that, we've got the market profile. We then have the footprint chart, the price ladder, and then obviously the bookmap. Now from left to right, the amount of lagging versus leading information varies, and this is what we're going to discuss in the next slide. Now before we move on and talk about some of the advantages and disadvantages of each tool, I really want to highlight that it's not a case of simply one tool is better than the other. Like I said in the previous slides, it's about understanding how you can utilize each tool to extract meaningful information to make effective decisions. Now, what I want to highlight is that sometimes lagging information is important, and sometimes we can utilize lagging information, but that lagging information needs to correspond with the type of trade strategy we're trying to execute. Let me illustrate with a basic example. If we want to become very good breakout traders, then lagging information is of no use to us. Because lagging information, by the time we get that information, say via a close of a candle, or say via a moving average, or whatever it may be, by the time we get that information, the market has already utilized that information and moved accordingly. So in the example of a breakout strategy, we want to utilize leading type tools a lot more than lagging type tools. That being said, if we're looking at specific turning points in the market or key absorption points, in those instances, we don't want to use things like level 3 data from Bookmap or the price ladder, because in those instances, the information is too quick and it's too leading that it won't add value to our trade strategy. So the important thing to note is that it's about utilizing a tool, whether it's lagging or leading information, and utilizing it within the right trade strategy. And that's why, as we spoke about earlier in this unit, we highlighted the 10 different trade strategies and how we're going to effectively build those trade strategies throughout units 6 to 15. Now, before I get going with this, these next two slides, where we talk a little bit about the strengths and the weaknesses of each trading tool, I really want to drive home the idea that, again, it's not about one tool being superior to the other, but about having a cross-pollination between the tools and utilizing the tools within each strategy where they can be most effective. Okay, for me as a trader, I utilize predominantly the market profile for context, the price ladder for execution, and the footprint for building confidence and perfecting timing. Now, what I'm going to go through throughout this slide and the next is I'm going to start off and I just want to drill down the weaknesses of each one of the 5 trading tools we spoke about earlier, and I really want to highlight how the footprint, it's almost like the weaknesses of these tools are actually the strengths of the footprint. And through this, what you're going to see is that the weaknesses of one tool will be a strength of another tool, and vice versa. So by that definition, if you're very good at, say, the footprint and the market profile and the price ladder, you have a really all-round good you have a really good overall arsenal of trading tools. Now, the first tool I'm going to talk about is the most lagging, which is your traditional trading tools. So obviously your candlesticks with your candlestick tools like your Bollinger Bands and your moving averages, etc., etc. Now, the biggest weakness is that the information is very stale and it's very lagging. And most importantly, these traditional tools tend to ignore actual market flows. In other words, like I was showing you earlier in the example, when we drill down the traditional candlestick, it's simply showing you the open, the close, the high, and the low. It's not showing you any kind of flow or interaction going on between the buyers and sellers. Now, when we move on to the next tool, being the market profile, some of the weaknesses in the market profile include that it can be highly subjective. So because it's all about shape and pattern recognition, it can be quite subjective in nature. Also, it's quite a lagging informational source. In other words, as the profile is being developed, that information is obviously very lagging, because we need to wait for the completion of that profile before we can start to talk about principles around shape and pattern recognition. Also, the market profile includes only price, time, and volume. It doesn't include the interaction or the order flow within each price. Now, we're going to leave the footprint out at this stage, and we're going to talk about that on the next slide. So the next sort of trading tool, which sort of almost tips the scale between lagging and leading, this is a more leading type trading tool. Its weaknesses can include that it can be particularly fast. Okay, a lot of the time with all the noise going on around the ladder, it can be way too fast to make any kind of a strong interpretation. Now, don't get me wrong, you can develop some extremely good trading strategies just utilizing the ladder, the price ladder, but again, that'll be limited to things like velocity trade strategies or very specific unique scalping trade strategies, as opposed to making bigger decisions. Now, obviously, there is a lot of noise that comes with the price ladder and a lot of spoofing that occurs between all the computer programs. And again, the price ladder can be highly subjective in a sense where, one trader might say, oh, can you see all that buying? Where another trader says, well, yeah, that's being absorbed by sellers. So it can be a highly subjective trading tool as well. And again, obviously the price ladder, it only includes price and volume. So it doesn't include any kind of relative changes. It doesn't include any kind of snapshots or summarized version of what's effectively occurring on the price ladder. And then lastly, the most leading trading tool, which is like your level 3 data or your bookmap tool. Okay, again, these are just a significant amount of noise. You're seeing every single little contract being traded by algorithms. There's 1,001 different trade strategies going through on this trading tool. So it can be very, very noisy and nigh on impossible to make effective discretionary type trading decisions. Obviously, if you're an automated trader, then this will be a tool that you'll utilize effectively because it's the information that corresponds to the type of strategy you're adopting. And again, obviously note the type of strategies you can take on with highly leading information are very unique. Okay, so they're very much scalping type trade strategies. They're not going to include longer time frame or swing type or day type trade strategies. So those are the weaknesses that we find, within both the lagging and leading tools, not including the footprint. Now, we're going to move on to the footprint tool, and we're going to talk about this footprint tool now in terms of its advantages, and you'll see how those advantages effectively cover the weaknesses of the tools that I've just spoken about. Now, I really hope I'm not coming across very biased, because that's not the purpose of these slides. I think the most important aspect is, again, I want you to adopt a cross-pollination of the strategies. And what you're going to see throughout Units 6 to 15 is in every practical example where we're applying the strategies, I've not only included the footprint because I want you to be able to recognize the trade strategies with the tools that you understand, but then see how those trade strategies play out on the footprint and how the advantages within the footprint cover the weaknesses within the trading tools you currently adopt. Okay, so let's start off and talk about some of the weaknesses of the footprint tool, because again, it's important that the footprint definitely does have weaknesses, and it's important to understand those as well. So the first, the first weakness is that the footprint can create a lot of noise if you do not set it up correctly. And that's the purpose of the first 5 units. I'm going to get you to set up the footprint in a very simplistic manner. Also, as I will warn you as we go through units 2 and 4 and 5, is that don't change your settings too often. Don't, when something's not working or you're not necessarily understanding the information, don't look to change the tool just to see the information in a different manner. Okay? There's a reason we set up the tool very simply. It's because it can give us effective information that we can make strong decisions upon. So the first thing is that if you don't set up the tool correctly, it can be a lot of noise. And then the second thing is that there are a multiple number of ways that you can set up the footprint tool. I mean, there's so much information coming in, there's so many numbers, you're seeing effectively all the information, all the every single contract being transacted. So there can be this feeling of overwhelming when you're looking at the footprint tool. So those can be the weaknesses associated with the footprint tool. Now, the strengths of the footprint tool, and this is where I get very excited, and I must tell you that for me, the footprint tool is a real breakthrough in my career, because I always felt like I was missing something that could give me the confidence, to execute my strategies with a little bit more leverage, and it was ultimately the footprint tool that's given me that confidence. Now, that confidence came because I was feeling like there were certain weaknesses I had with the tools I was utilizing, and once I found the footprint, those weaknesses have now become covered. So some of the strengths of the footprint tool, first and foremost, is that it's a leading informational tool. In other words, we're not utilizing lagging information. Why? Because as every contract is being bought and sold, and we're seeing the physical interaction between the buyers and sellers, that is as leading information as you can get. In other words, when every buyer is buying, we can simply identify him buying, we can jump on the buying, and we can execute with the buying, rather than waiting for all that buying to be represented by, say, a candlestick, and then we've missed the buy opportunity. Then, the tool captures the most relevant information in one graphic, and that's something that's very important, is that, like I said, one of the weaknesses is there's a lot of information, but if you set it up correctly, the tool can really capture all that information in one simple graphic, and that graphic is simply color-coded. So we have 2 colors, blue and red, and 3 different shades. And all that information boils down to simply 2 colors and 3 different shades. And that for me is unique. It's a lot of information that is summarized in a very simplistic manner. Then, the tool includes price, time, actual volume only, delta, relative market changes. So it includes more information than any other tool that we've observed. Because of that reason, I'm very attracted to the trading tool. Note, it's a relatively simple trading tool only if set up in such a manner. Also, it's a relative indicator, and this is important as well, because what you'll see when we get to units 6 to 15 is we do develop trade strategies based on relative shifts. So it does show us the relative changes in the volume, in the delta, in the velocity, in the volatility. Then it shows us only the actual volume traded, and this is where it trumps the price ladder quite significantly, is that the price ladder can show us a lot of spoofing and a lot of fake orders, whereas the footprint only shows us exactly what is being transacted. Note, it's an objective fact-based tool, and this is particularly important, is that we're not leaving the decisions on opinions or subjective information. We can see the buying coming into the market, we can identify a strategy around this buying, and we can execute on fact-based information. Then, the footprint can be utilized as a standalone tool, but also with other tools. And this is also fascinating because a lot of the time, for example, a price ladder, of course, it can be utilized on its own as well and with other tools. But there are certain tools that, on their own are less effective than when they are combined with other tools. Now, the footprint is as effective on its own or in combination with other tools. It boils down to which trading strategy you're adopting with the tool. And lastly, and the most wonderful thing, is that the footprint tool ultimately allows you to perfect your timing. Why? Let's say, for instance, you have a trade strategy of a breakout and you're looking for a market to break above a previous important high. Now, you can perfect that timing simply by watching the interaction between the buyers and sellers. Not only can you see the interaction, but you can see the commitment and the initiative and the response taken by other participants just utilizing the footprint tool. So ultimately, that will give us a lot of confidence, which ultimately allows us to leverage up. Now, again, I'm going to reiterate this one last time. It's not a case that the footprint is significantly better. For me, it is a brilliant standalone tool, but it's an amazing great tool when combined with the price ladder, as well as some of the lagging tools like the market profile and candlesticks. Now, in the next slide, we're going to move over and we're going to see the footprint in action. We're going to watch a video of it. I'm going to talk you through the basics of how it's rotating, and then you'll get an understanding of what it looks like in action.